This FTMO challenge did not fail because the market was random. It failed because the risk was not contained. The account traded only ZOZD, imported 743 MT4 execution records, and ended with a realized close trade loss of $885.33. The challenge rules were a 10% profit target, a 5% daily maximum drawdown, and a 10% overall maximum drawdown. On paper, that is a very clear framework. In practice, the trading process ignored the part that matters most. The win rate was 60.57%. That sounds respectable. But the average win was only $1.66, while the average loss was negative $5.57. That means the loss was more than 3 times the size of the average win. The expectancy per trade was negative $1.19, and the profit factor was 0.458. So the account was often right, but it was right in a way that did not pay. That is the core lesson here. A high hit rate does not matter if the payoff structure is broken. The monthly path makes the problem even clearer. July lost $37.69. August lost $238. September lost $609.64. The sequence was not just noise. It showed the same structural weakness getting more expensive over time. September looked strong on the surface, with a 77.43% win rate across 226 trade episodes. But again, surface metrics can mislead. The records show that the top 5 losing trades accounted for 39.06% of total losses. That means a small number of adverse moves did a disproportionate amount of damage. The account also showed clear concentration risk. All 743 records were in one instrument, ZOZD. Concentration can be acceptable if the trader truly has an edge and a hard risk limit. But here, the position behavior made the account fragile. There were 99 same-direction overlapping entries and 68 loss-following size escalations. There were also 292 comparable loss transitions, which suggests repeated interaction with adverse conditions, not one isolated mistake. The operator's own reflection matters here. In August, the DCA bot was being used to test whether daily target returns could be beaten consistently. In September, parameters were adjusted, and lower spreads helped a little, but they could not fix the structural weakness. The bot was not programmed to prevent a max daily drawdown breach, and that became decisive. That is why this challenge failed. Not because DCA is inherently evil. Not because gold is impossible. And not because the win rate was low. It failed because the strategy did not actively control downside. Risk was left to the entry logic, and entry logic is not a risk system. A professional framework would ask a few simple questions before each trade. What is the maximum acceptable loss for the day, for the symbol, and for the sequence? Does the entry still work after spread and slippage? Can additional exposure be added without making the account more fragile? And if price moves against the position, what exact rule stops a small mistake from becoming a challenge-ending event? The conclusion is straightforward. This account could often be right in small increments and still be wrong in aggregate. That is exactly why sophisticated traders study loss structure, not just accuracy. Survival comes first. Downside must be designed before growth can compound.